Today we have a presentation as promised to go over. We're going to be talking about real estate. Everyone loves real estate. So real estate is a math from beginners to investors, how to analyze a multifamily deal. Why you must know how to run the numbers. 90% of people look at price. Investors look at numbers. Price do not make a deal good. Cash flow and returns do. So very, very important is to look at the cash flow, and if there is a cash flow, because I see a lot of investors, they just invest with a hope that there is a promise someday they will make this money, but you want to make sure that the cash flow is there. Cash flow is there right away. So, and we're going to be talking about this as well. So today I will show you how to tell the difference between an investment and a problem and a promise as well. So we're going to go and dive deep into the 32 units. So this would be a deal I'm going to share with you. The price for that deal is $6.2 million. And obviously the broker says it's a great opportunity. It's a great deal. Let's buy this. Let's sign the deal. But we're going to learn how to actually look at it and see if it's a good deal or not. And how do you actually know if it's a good deal? We will cover today what an offering memorandum is, known as OM. The key real estate terms. We'll review the 32 unit deal, how underwriting really begins, and the basic underwriting flow. So what is an OM? OM stands for the offering memorandum. It's the presentation of the property prepared by the broker. Its purpose is to sell the deal. So it's very, very important to understand that the whole purpose, obviously, of this offering memorandum is for you to get the information, but not fully just to rely on that information, because all this information is going to be nicely presented and packed for you together. So you can actually buy the deal, because the whole idea, the whole purpose of the OM is to sell the deal. But seeing of the offering memorandum, getting all the data, you need to make sure that you do your own research as well. So what's going to be included in this OM? You'll see the photos, the pictures of the property. You'll see the location, the income, expensive, growth potential, cap rate, floor plans, area, demographics. And again, very important to understand that OM is a marketing. It's not just the final analysis. So you need to take that information and do your own underwriting as well. So, and the key terms you must understand when you're analyzing a deal, you need to understand net operating income, what is cap rate, the vacancy, expense ratio, and cash flow as well. And then you'll get all the information of the brokers, who is the broker, the company, and you'll get all the summary of the property. And by the way, here's another thing, and we're going to be talking about, you see, I already briefly mentioned to you that in the OM, you're going to see the occupancy. So you see it's outlined here. You see the offering price. So sometimes they put the offering price like in this particular deal they do. Typically in the small deals, they put the offering price. If it's a big deals, big projects you're working on, you're not going to see an offering price. And you might see the cap rate, and sometimes you will not see the cap rate. So the way is you're going to see the offering memorandum. You will need to review and underwrite the deal, and then you need to come up with the price. So it's not going to be here. And in the large deals, you'll see that typically the brokers, they will say, oh, we're accepting all the LOI. This is a letter of intent. So that's another term, letter of intent. So they would say we're going to be receiving all the LOIs, let's say like on March 31st, like by that day, submit the LOI. So typically what the brokers do is that they're receiving all these letters of intent. And then they're looking at obviously the best and the final deal that they're going to choose from the highest deal. So a lot of the times you're not going to see the offering price, but the way you can actually underwrite what's the price, or whenever you're going to speak to the broker, you can ask them what is the whisper price. So that's another term for you to know, is the whisper price. So whenever you don't see the price, then you just typically ask the broker, okay, like what would be the whisper price? Okay, so also, as you see, the number of the units you see here, and then the price per unit. or if it's very important to know the price per unit as well. So why? So like this way you can even like looking at this property like 193,000 price per unit is it's a good price. It's very decent. So the way you look is okay. What does it cost today to rebuild the same unit? So that's why would that be important. So you'll see the size of the building of the unit. So all of this would be on the offering memorandum. Obviously more pictures as you see, and you see the map. So the map is very important. Why is the map important? So we typically, whenever we underwrite the deals, we look at the map. And in the map, we look at many different things. So one of the things I love to look is how far is Starbucks, how far is Trader Joe or Whole Foods. Why? Because the Trader Joe, Whole Foods, or Starbucks, they do their own research. So if you see the location next to the project which you're trying to buy, so you already know it's a great location, because Starbucks or Trader Joe, Whole Foods, they wouldn't put their stores not in a good location. So like that's an indicator already that it's a great location, and location is very important. So there is a few things what you're going to be looking when you're buying the property, and location would be one of them. So not just the price, and many investors, they're looking at the price or the cap rate. But that's not what you should be looking at. So, it's again analyzing the deal, but the location, is very important. That's one thing that I definitely learned from Grant Cardone is you want to make sure that you are getting the good location, because that's exactly what's going to help you to sell and exit the property and make the money. Okay. Also, you want to look when you look at the demographics. Obviously, if it's not necessarily it has to be like a Trader Joe, Whole Foods. So you also want to see, okay, where is like a Walmart or like a Publix, like some stores, because you want to make sure that it's a close by, so the people can go and shop. So that's important to look at. At the same time, you want to see in the map is what's around in terms of the work. If there is like a big hospitals, if there's like Amazon, so we a lot of the times we look at the Amazon location, brand new typically, better top location, better location. So obviously the average family income would be much higher. Also there's like a B plus properties. I mean, listen, it can be still at a great location. It's just B plus, so typically it would be like older property. It might be like in a great location, but the property is just already older, so that would be a B plus property. And they might be like C class, so like this is already a lower. Average lower income family location. So again, it all depends on what is your business model. I'll tell you, even I have a few clients that are specifically just buying in this type of locations. Because their business model is that they have like this low income family, they have this Section 8. So if you are buying and relying on these government programs and you're not so much into the income, so that might be working well for your business model. And typically the cap rates for this type of property is much higher, so meaning that there is a better cash flow. So obviously there's advantages and disadvantages. There's high risk in this type of properties, but then on the other hand, the advantage would be that potentially if you would be able to lower the risk, you can have a higher upside in terms of a better cash flow versus with the Class A properties. So that would be another thing that you would be looking when you look at the demographics and at the map. So, all of this, as you see again, the investment overview, like it will all show you like the retail, the healthcare industry. So like you want to make sure to look up into all of this, because, you want to make sure that the people want to actually come to this neighborhood and live in this place. Also, you're going to look at the building, the structure components, the years, the building size, the stories. So like all of this important as well to look at. More of the pictures. And so you'll see the pictures of the apartments itself. So this is a multifamily. So a few of the things here that I like to point out, you see, again, like when you're looking at this, you need to make sure that the pictures there is that real pictures or this is a projection pictures. So like in this particular case, you see like they're showing you, okay, like this is what it is there right now and what's the upside, what's the potential. So typically it's called add-on value with the old projects when you're buying this like old building as these ones. So the add-on value would be is when the tenants move out, then you can renovate the units, and once you can renovate the units, okay, this is how it's gonna look like, and then you typically with the add-on value after renovations you can increase the rent. So that would be the upside. So again, a lot of the investors buying just for this because they wanna get into the add-on value into the properties, do the renovations, increase the rents, and by increasing the rents, this is how you increase the value of the property. Again, it all depends like on the business model, but you want to make sure that you actually, okay, like whenever you're buying, was it renovated? Because sometimes, I look at the properties and they say, oh, it's renovated. But then when you start analyzing, okay, like out of this, let's say like out of the 32 units, only maybe like 4 or 5 were remodeled and the rest you need to do it yourself. Like these are all the important factors for the underwriting because you need to make sure that you factor in the CapEx. CapEx is the capital expenditure amount. So these are all the things that you will see in the OM as well as the financial analysis. And we're going to talk more about it. So like you'll see all the numbers, but let's talk about a little bit more about the numbers before we're actually going to jump into them. I'll give you some of the meanings of these numbers. Okay, airport, university close by. Yes. So this is, thank you, Venera. Yes. I mean, airport. Yeah. I mean, like, I don't think I want the airport to be close by. I'll tell you, even some of the, there was some of the properties, I looked up the airport, like literally was like right by the property. And I remember me and my husband were like, literally with the numbers, it was a great property. Some people okay to live there. I don't know. It's again like it's still very like challenging. It would not be considered Class A. But I remember me and my husband when we physically went to the property to walk the property, and then the airport is literally like right behind the property, and the flights going up literally like every 5 minutes. So that's another things to consider. I don't think it's it's like a disadvantage to the property, that I would definitely say. And as far as the university, by the way, there is advantages and disadvantages with the university. I'll tell you, there was one particular deal that I was looking and I actually was working on for a while. But after doing the in-depth analysis, besides just the numbers, but after reviewing the leases of all these tenants, it turned out that 90% of the tenants in that specific property, they all were students. So that's another, upside and a downside. And the downside would be and that's exactly what happened with that specific property, is that when the semester ended, all the tenants would move out, and then you have all this vacancy, and now like you need to start all over again to bring the tenants in there. So like that would be downside. Another downside is when you want to put a mortgage on this property, the banks do not like that. They do not like that the tenancy is there. That would be another downside. And another downside with students is how they're actually going to pay for the rent. So then you need to co-sign the parents, or the parents need to take the lease. So that would be another downside. So you see, like all of these things are very important to know whenever you're underwriting the property. Let's look at net operating income. What is NOI? Net operating income, it stands for NOI, is the property's profit before debt. So the formula to calculate NOI is you take the income, gross rent income, okay, minus the operating expenses, and that's equal to NOI. So you want to see and calculate NOI because the NOI, it shows you the profit before you take the debt. So it's very important because it's important to remember that the mortgage payments are not included in NOI. And the bank actually, whenever you want to get the mortgage, the bank will calculate the NOI, and then from that NOI, they're going to see how much debt it can support. So that's another important thing to know. So what counts as income and expenses? So let's talk a little bit more about this. So the income includes the rent, whatever rent you collect from your tenant, and also there's other income. So depending on the project, so they can be parking, so you can charge separately for the parking, you can charge separately for the laundry. Some properties, obviously bigger properties, so they would charge if there's a lot of properties. Look, the bigger the property, the more you can charge. They will charge for the internet. They can charge for I mean, we did mention already parking. They would charge for trash removal. As far as the expenses, there's different types of expenses: property taxes, insurance, management, repairs, utility, and administrative, marketing, and many others. So that would be all part of the expenses. So now, how do you calculate net operating income? So we'll calculate this specifically in this example, in the story 2 units that we're underwriting. So as you already know, the net operating income equals gross income minus operating expenses. So how do we calculate gross income? So here's an example, the way to calculate gross income. So it's 32 units, right, in this particular case. 32 units, and then we have the average monthly rent is $1,523. Multiplied comes out to $48,736 per month. And then times 12 months, because we have 12 months, so per year it comes out to $584,832 per year. So that would be your gross income. If you charge for all the other extra expenses, you would add them up to this gross income as well. Okay, so and then the next you calculate all the expenses. So I took this number from the offering memorandum just for the sake of the example. So in this case, the expenses that were provided was $261,870. So now what you do is you take $584,832. So this is the annual gross income, minus the expenses, as we already know. And then in this particular case, the NOI comes out to $322,962 per year. $322,962 per year. So that would be the NOI in this particular case. Okay. So let me just now, if you have any questions, if you need, for me to go over, explain anything, let me know. Okay, so now you know how to calculate NOI. So the next step is, what is the cap rate? How do you calculate cap rate? So the cap rate shows you a return without financing. So typically it's very easy to calculate. So the cap rate you would calculate is that you will take the NOI, as we already calculated. So you're already experts, you already know how to calculate NOI, and then you divide by the purchase price. So we already have this 322,962 is the NOI, and we're taking the price that they gave us is $6.2 million, right? So that's the price that they gave us for that project. So you see the way we calculated, our cap rate came out to 5.2%. The way they calculated on offering memorandum was 6 point something. And we're going to go in depth into this. So you want to make sure that you calculate your own cap rate, not the one that the broker is giving you. And obviously, why? Because obviously the broker, the cap rate will depend on the purchase price, and the cap rate will depend on if it's this project is profitable, if it's desirable for you to buy this or not. So obviously the broker wants the cap rate to be higher, because the higher cap rate, the more desirable project. Everyone wants to make more money. So basically when the broker says that the cap rate is 6.9%, that means this is how much you will be making money on your investment. Now the way we calculate it, it comes out that you're not going to be making 6.9%. You're actually going to be making 5.2%. And remember, remember that, as I already mentioned, that this 5.2%, this everything we calculate, that's all before even taking the mortgage. So if you're going to be taking a mortgage and putting money on your own money as a down payment, so you want to calculate what would be the cash flow. So cash on cash, that's what it's called, the cash flow. So what would be the cash flow on the money that you invest? So these are all very important to understand. You see, now you understand these numbers, you can make educated decision. Doesn't even make sense. Whatever is broker saying is this is what I'm going to be making, or the real numbers are going to be completely different. I already mentioned the higher cap rate equals higher risk, older property, or a weakened market. So that's typically with the higher cap rate. It would be typically like Class B, Class C properties. It would be not so as a great location, or it might be just a good location, but an older property. And why the risk would be high? Because if the property older, that means that now you need to invest money into the repairs. So these are all the risk factors. So the lower cap rate typically means it's a stronger market, it's a better property, it would be Class A property, it would be new property, more stable market. So, but then again, now you learn that the cap rate alone doesn't tell the whole story. So it's context of the matters and underwriting and reviewing this whole deal. So typically, as I already mentioned before, the offering memorandum, it's obviously for the broker, it's a marketing material to make sure that this all looks so nice and beautiful and pretty, to share it with you, to make it desirable so they can sell the property. But you need to do your own analysis and be your own investigator. So now let's go into the depth what Dmitry is talking about. So the first thing is when you notice that when I was writing the rent, when we were calculating the gross rent, I took the number of $1,523. Okay, so where did this number came from here? Let me just highlight it for you. So it would be this here, $1,523. So this is the average rent in place. So what does it mean? Average rent in place, it means the rent that is already tenants paying today. So this is very important, because when the brokers calculating, then they calculating based on the proposed rent. So they would call it proposed rent, or they would call it projected. So, but this is all projected. This is all proposed. This is something might happen, might not happen. So if it will happen, fantastic. You know, it's good for you. If it's not going to happen, you want to make sure that you're buying the property based on what's happening today. So, and today that would be the average rent in place. And you see, this is, it would be here on the offering memorandum. So you want to base the calculations based on that. So this is why I took the number $1,523. So here's a few things I would like to talk about in this particular case about the average rent in place. So you also want to make sure whatever is written here in offering memorandum is actually the real numbers as well. So typically the way I do this, it's very easy. Number one, today you can go to literally to the internet, Google it, find the property, and then see what is it being rented out for. So that's number one way of looking at it. So typically if it's like a large project, they would have a whole website, and you can go into the website and you can see how many apartments are vacant, what's available, what's the rent for the apartment. So that's one way. Another way, you can actually go to the rent.com and like all these other sites that rent the apartments. So what I actually found, I mean, you tell me, Dmitry, if you found that too. So sometimes whatever you find on the actual website for this property, and let's say like apartmentrent.com, the numbers might not be even the same. So that's another thing to factor in and to see, because again, like for the marketing purposes, you know, like the rent might vary, but you want to know the actual number. So what I typically also do is I call the place, I speak to the real person, and I pretend that I want to rent out the apartment. And then I ask them, okay, what do you have available? What's the rent amounts? And I physically walk into the apartment as well. There's few things when we're underwriting. So what we typically look at, we look at the T12. So T12 and T3. T3 is not here. You will need to request from the broker separately. but you do have the T12. So what is T12? T12, it shows you the real expenses that were actually incorporated by this property, by this seller, how much rent he collected for the past 12 months, all this other income. So it would be on the T12. So T12 that will show for 12 months, and T3 it's trailing 3 months. It will show you all the expenses for the past 3 months. So you want to analyze both of them. You want to look at the past 12 months as well as this past 3 months. And when we're looking at the past 3 months, what we also do is then we estimate the next 12 years, 12 months based on this past 3 months. Okay, as you see what Dmitry was talking about, you see in this specific underwriting, so the broker actually goes based on pro forma. The pro forma, this is what is the projected rent, projected income. Again, this is all projected. It might happen, it might not happen. If it will happen, great, then you're making all the extra money, but you want to make sure that you're underwriting based on today's current income. So this is very important. I like to point this out. And as you see like the difference now on the income based on the actual income, which is 553,000 in this case, and the projected income is 591,000. So you can see it right away, the difference of $40,000. So that's a lot. And then especially we're talking about for this small type of projects. So in any kind of properties, you can, when you're analyzing, you can see, okay, what's being charged, what's not. And a lot of the deals, especially like with the add-on value, when we're reviewing and analyzing, we see, okay, like what are some of the things? Like, let's say you see like they're already charging here for laundry. So let's say if we reviewing the deal and we're looking at what other expenses they're being charged or not. Let's say if the laundry was not charged. Okay, so what we can do to improve, to increase this income. So let's say maybe there is no even laundry installed in the units and none available outside. So then this is something like an add-on opportunity. One way you can look is you can install the laundry into the units and then this way increase the monthly rent. Or another way you can have like a separate designated space just for the laundry and then potentially charge for that as well. So there's different ways how you can look at in terms of creating extra income. So some properties look for the insurances. So like they make all the tenants to buy home insurance and then they make them buy through their own like insurance company they get affiliated with. Some properties look at installing this cable services and then they make all the tenants use that specific cable service from which they have like a percent of the income. So there's different ways you can be creative how to have all this extra income coming into the into this property. Yep, great. Thank you. Great observation. Thank you, Dmitry. All right, so now let's go to the expense part. So now if we're going to the expense part, okay, so you will see all of this in the offering memorandum as well. Again, as you already know, you see the first column would be T12. So this would be all the actual expenses. So here's another thing to why it's important. You see, when you look at the T12, look at this one. So it shows you 12 months up to April 2025. We're already in 26. So that's why you want to make sure that you get the T3. The T3 will show you the last 3 months on the date when you're underwriting. So let's say if today is March, I'm underwriting in March, then I want to see the T12 that would cover December, January, and February. Because these numbers were last year's numbers. So there was like a whole year already after that came into the, already passed. And you want to make sure that you get the most recent financial statements. Okay. Also, again, this is the real numbers, as you already know, and this is the projected numbers. So as you see, based on the real numbers, now you're an expert, the net operating income here is 320,276. Based on the projected numbers, the net operating income is 411,000. So you see it's much higher. Of course, the broker wants the net operating income to be much higher. Why? Because they want to sell at a higher price. So this is how they came up with the 6.2 million sales price, because they were basing it based on 411 net operating income. But if the real income, as we already calculated, 320,000, then the actual price for that property would be like close to $4 million. Based on today's mortgage rate, based on the actual expenses. So you see how different all of this now. Because if you just will buy based on this pro forma, based on the broker's projection, then you're not going to be making any money, and maybe even you're going to be losing money, because you're not going to be cash flowing in this property. So a few things to point out here when you going through the expenses. So it's very important. You see, like here, these are all the list of all the different expenses: real estate tax, electric, gas, water, insurance, like all the expenses that the property is paying. So real estate tax. So you cannot just take the number based on what the seller pays. So you need to project how much you actually going to be paying once you close on this deal. So this is very, very important, because this is typically there's few reasons why the deals do not go very well. Real estate tax and the insurance would be one of the biggest reasons. Why? Because typically when you buy the property, so the real estate tax will be changed based on the amount that you're purchasing for. One way to analyze and to project the real number is to go to the county clerk, and then on the county clerk, based on the purchase price that you're purchasing today, you can actually estimate what would be your property taxes. So that's very, very important. A lot of the times, you know, like there was a lot of deals that we went to and we bought it, and we even though we underwrote the real estate tax with the potential increase, but then the county comes in, then they make an assessment, and the tax goes up by 100,000, 200,000, and that's going to eat up your profit. So it's very, very important to make sure that you get as much as you can closer to the real number. So the same thing with the insurance, especially like in Florida when we buy the properties, and I see a lot of the clients go through the same challenges. You know, they estimate the insurance to be one price, and then when they actually buy the policy or, you know, purchase the property, the price goes double and triple. So again, it's going to eat up your prices. So one way to get the estimated price is when you're underwriting the deal, you go to the broker, and then you get the quote. So make sure that, you know, it's the quote that you're going to be paying to. There's a lot of surprises in that case too. Insurance brokers, they like estimate and give one quote, and then at the closing you get like a full surprise where the quote is 2-3 times higher than what you actually was projected in the beginning. So again, it's going to eat up your profits. That's why it's important. So especially like I mentioned in Florida, or if you are somewhere near water, but you definitely do want to buy the insurance. It's not something where you want to save money on. Okay, so and also there's all the other expenses. So just make sure that you take the real expenses, because what the broker might do, they might like lower the numbers. You see, like here specifically, they had a payroll of $36,918. You see, like they had a payroll here, but then in the pro forma, they actually making the payroll $14,400. So like if you already have someone that you're paying, taking care of the property, then you're paying them $36,918. Like, why would you pay someone else? See, like these are important things. These are red flags that you need to take a look at, and then make sure that you are estimating the right numbers when you're underwriting this property. So the same thing here for the repairs. You see, the actual repairs for $41,316. They putting here only $14,400. Like, why would you pay less for the repairs? And then especially this is an older property. So obviously, being an older property, you're going to have much more expenses in the repairs. So that's another thing to pay attention to. And talking about repairs with the older property, there's such a thing as called CapEx. capital expenditure. So that's another very important allocation. A lot of the investors buy the properties without factoring this. You do need to factor this. So when you do the actual inspection of the property, if it's an old property, like changing the roofs, changing maybe like there's something with the plumbing or the windows, or siding, like anything structural with the old properties, you want to make sure that you have a reserve for the capex. What does that mean? It means that if it doesn't need the repairs right away, but then you have enough money to in the reserve for the repairs, or if it does need you do need to do the repairs, so then you have enough reserve for the capital expenditure as well. So you see, like, there's so much that you need to know and calculate and factor in. And as you see, based on the pro forma, the broker didn't factor even in any capital expenditure. So they make the numbers to look nice and beautiful and pretty. But is it actually real numbers or not? So now you're experts in the underwriting. You already now know some of the terms. You know what is NOI, what is cap rate, and how to underwrite your own deals. Thank you. And remember, guys, financial freedom is all in your hands.